For this edition of Conversation on Alternatives, we are joined by Ian Loke from our Private Markets and Alternatives team. Investors had a lot to process in 2023, and portfolio managers in alternatives had a challenged year. In the first half of 2023, a balanced portfolio of bonds and equities returned close to 9%, while hedge funds, private equity, and private credit returned mid to single digits in performance, and returns from real estate funds, on average, is still undergoing contraction. From the various conversations you've had with investors this year, what are some of their biggest concerns regarding alternatives investments right now?
Right, thank you, Vileg. So the performance of most alternative asset classes have moderated relative to public markets in recent vintage years, as you have correctly pointed out. And certain segments have even generated negative headlines, for example, North American office real estate. But we still think that many investors, they tend to adopt a mid to long-term horizon when investing in alternatives. So most investors have therefore maintained their exposure despite recent distractions, as they seek to leverage vintage diversification to build durable, cycle-resilient portfolios. Now, having said that, we do observe that many investors have become more selective about their allocation, so they have chosen to prioritize capital to areas within the asset class which are either more defensive or likely to thrive within the current environment of moderating growth, elevated uncertainty, and of course, higher cost of capital.
With the holding pattern in tight financial conditions and slower growth, we do expect the recovery in deal volume and transaction multiples to remain gradual. The good news is, key risks like higher cost of capital and economic uncertainty is priced to a larger extent in alternatives. Looking ahead, where do you see the opportunities in alternatives?
Yeah, we do believe that investors would continue to focus on playing defense and investing behind segments with the potential to outperform under the current economic climate. We should continue to see an orientation towards investment opportunities that afford downside protection with ideally some equity optionality. So senior secured direct lending would be one such area. For example, from a sector perspective, that would be businesses and industries with infrastructure-like characteristics, monopolistic pricing power, for example, mission-critical logistics networks and warehouses. We talked about enterprise software and even some aspects of North American professional sports franchises and platforms. Ultimately, investors would still favor investments alongside strong sponsors with a hands-on investment modus operandi, for example, activist hedge funds, or middle market private equity buyout managers with deep operating capabilities.
Thank you, Ian. Thanks for joining us on this edition of Conversation on Alternatives.